chapter 6, we're going to talk about cash, fraud, and then how internal control structures are very important to accountants. So our internal control system is basically what the company does internally to monitor and control their day-to-day financial business activities. So this should hopefully be all written and put into their policies and procedures, but ideally it's to protect assets against fraud, to ensure that the accounting is accurate and reliable, to uphold their policies, and then hopefully promote efficient operations. So the Sarbanes-Oxley Act came into play in the early 2000s when we had several accounting scandals, large accounting scandals such as Enron, and then the fall of Arthur Andersen that was related to Enron. So what happened then is that the Securities and Exchange Commission set up this Public Accounting Oversight Board, the PCAOB, and they said that this organization needs to look over the auditors of these publicly traded companies so that they are actually looking at internal controls, they are auditing the internal controls, and that everything is really where it should be. Just because some of these accounting scandals, the auditors had reviewed and these were audited financial statements, and it went through. And did the auditors have some knowledge of it? That's the question at hand. And how were these executives able to commit the fraud? So there must have not been effective internal controls. So now all this stuff has to be in writing. The auditors have to verify it's occurring in practice, and then everything is kind of double checked. So this committee of sponsoring organization has these 5 ingredients to internal control. So the control environment, risk assessment, control activities, information communication, and monitoring. The principles of the internal control is to establish responsibilities, maintain adequate records, ensure assets and bond key employees, separate record keeping from the custody of assets, divide responsibility for related transactions, apply technological controls, and perform regular and independent reviews. So these are going to be, again, just kind of broad ones that almost all companies are doing. Then we'll get into each one of these in a little more detail. So establish responsibilities. So the tasks are given to one person so you can determine who is at fault. So like, let's say, for instance, like if you've ever gone to the grocery store. So say you go to Acme and you're at a shift change. As that one cashier leaves, they take their cash box with them and they take it over to the customer service or the cashier's office or whoever it goes to. But then the other cashier has their own cash drawer. So nobody's sharing that cash drawer just in case it ended up short. Whoops, I've moved over slides. Just in case it ended up short, you would know, well, hey, Joe is the one. I'm sorry, I keep touching the button. Joe is the one who had that drawer and he ended up $50 short. And then you could kind of identify if there's a trend or something along those lines. Or let's say you accepted returns. Well, returns can only be taken to the customer service desk because that is their responsibility. Can't take it to any cashier because they don't have the responsibility to do that. That way we know that there's one person who's given people credit on their account for things that are supposed to have been returned and can be accounted for. Maintain adequate records. So like keeping pre-printed forms. So you're obviously all your checks are numbered. Your invoice numbers should all be, you should have those pre-numbered and you should follow in a sequence. Any missing numbers have to be accounted for. Purchase orders are all pre-numbered. All of those things, your sales receipts are going to have a specific number on it. Then that way anything that's voided or missing has to be accounted for. You can bond key employees or at the very least be doing background checks. But like say you work at a bank and you're handling a lot of cash, they may very well bond you. And what the bonding means is they have like an insurance policy against any theft on that person. And sometimes people who come into your house, like, or if you listen to ads, they'll say, oh, this person is bonded. So if they come into your house while you're at work to like replace your windows, again, there's an insurance policy that you could collect on if they did steal all your valuable assets. So companies can do that same thing. Separate record keeping from the custody of assets. So say that you work in the stock room and you're moving inventory in and out. You should not also be able to go to the computer system and enter in the inventory that came in or that was moved out to the departments. Like that should all be done by a separate person so that you can't cover your own theft. And again, like it says here, you'd have to collude. You'd have to have the person who's entering the inventory transfer or the sales or the purchase order or whatever, where you're entering that inventory into the system. You'd have to like collude with them, meaning you guys would have to get together to commit the fraud. It would take more than one person. Divide responsibility for related transactions. So a transaction should be divided between two or more people so that one person is acting as a check. So like, let's say, for instance, you're the accounts payable manager and you print all the accounts payable checks. You should not also be able to sign those checks. Those checks should then go to the controller to be signed, or something along those lines. Or say you're the shipping and receiving person and you've signed off that you've received all these goods. Somebody else in accounts payable is then going to match those goods to the purchase order and make sure that those all agree before they pay the bill. So those are examples, again, of just a division of the duties and the responsibilities. There can be a lot of different technological controls that build into the computer systems. So like for instance, like a cashier won't have the authority to void a sale. She's going to have to go get her manager and they come in and they enter a key. I'm sure that's happened to you, like at the grocery store or something like that. Time clocks. It's not, people aren't just writing their times down on a piece of paper. You're putting it in, you're putting in, or you're signing in with your login and it says, okay, it's exactly 1:15 and you're starting on the job. There can be ID scanners that you only have the ability to get into, like the inventory area if you have a scanned ID to get in there, or like say you have like we kept our checks in a locked room. Your scanner isn't going to open that locked room unless you're able to access those checks, things like that. Even in the computer system itself, like say you're the inventory handler, maybe you can log into the computer and do limited functions, but you cannot do the functions that would either put that inventory into the system or take it out, because you will not have the authority under your login to do that. And then there always should be regular and independent reviews. Sometimes that is done by internal auditors. Sometimes it's done by like the accounting manager or the controller. And then it can be done by the auditors that are looking at the financial statements at a broader level at the end of the year. Blockchain is a secure type of an accounting ledger that is verifying that ledger, and so it's going to prevent any type of modification without detailed record changes, and then those changes can't be hidden or destroyed. So there's going to be like an electronic trail of anything that gets changed, and then the auditors can go in and look at that blockchain and see what has happened. So the dilemma that we have with internal control is obviously people can make mistakes, whether it's on purpose or they're just careless or they didn't understand. It could also be fraud, that they intentionally are not working within the internal control procedures so that they can steal or that they can cover, commit accounting fraud or whatever. And then back to, I think, chapter 2, we talked about that fraud triangle where you have to have the opportunity to commit the fraud. some sort of a pressure that makes you want to do it, and then that you rationalize your behavior. So again, like say you're stealing money, you have just declared bankruptcy, you see that nobody really double checks and counts your cash drawer when you turn it into the cashier's office, and you rationalize it by saying, I'll pay it back later. I'm going through a rough time right now, or they owe me because they haven't given me a raise in years. But as we put these internal control procedures in place, obviously we could go hog wild and have it as strict as we can possibly imagine. But then this cost benefit analysis comes in and says, okay, well, how much is all that going to cost? And is it worth it? Yeah, you might catch Joe from stealing $50 out of that cash register, but are these internal control procedures that you want to put in place going to end up costing the company $50,000? Do you know what I mean? So obviously, let's let Joe steal 50 versus us paying 50,000 to catch Joe. So you're going to look at all of those things and say it has to be, reasonably that we're going to end up doing more good than what it's costing us to do. Whoops, did I go too far? Okay. So when we talk about cash is obviously the most sought after of if we're going to steal something. So again, not accounting fraud, because accounting fraud is just manipulating the numbers. But if we want to actually steal something from the company, it's probably going to be cash. And so we have to be very careful with our internal control structures as it relates to cash and protecting our cash. So the people who handle the cash should be separate from the people who record the transactions that relate to cash. So if you're the cashier, you should not be entering those cash receipts into the ledger. Cash receipts should not be hung around. Like you shouldn't put them in a drawer and get to those later. Those should be taken every day and deposited into the bank. You could possibly do those after hour bank deposits where they've got the little drawer that you put it in. So at least you're getting it off site and getting it to the bank as quickly as you can. Cash payments should either be made by check or by electronic funds transfer. So you shouldn't have a large amount of cash hanging around to make any cash payments. You could have a small petty cash box, but it shouldn't be a large amount. So cash equivalents, and liquidity. So cash is not just physically cash that you can touch and hold. It also relates to all of your deposit accounts at a bank. So your checking accounts and your savings accounts. Those are all things that are also considered cash. Cash equivalents are more like money markets, things that you can quickly convert and turn over into cash or transfer into your checking account. So those would also be considered cash equivalents. And then we want to manage our cash. So as we look at it to say, okay, we want to have a certain level of cash that we have available to pay our bills, but you don't want to have too much cash, because you could take that extra cash and either pay off debt or invest it. And then you can prepare a cash budget to see, okay, well, when do I really need cash? And then how can I either invest it in that short term or pay off a line of credit in that short term, just something to be actually making money off of my available cash. So effective cash management, we obviously want to collect on our receivables, and we want to collect as quickly as we can. We would like to push off our payment of liabilities, because again, that just means we hold the cash longer. So maybe we don't pay people as quick as we can. We wait until that last minute. I've worked in industries where we would pay in 45 days. Doesn't matter if the vendor's terms are net 30, we're going to pay in 45 days because that's our policy, and that's what we do. And if you're a big company, you can get away with that. As individuals, we cannot, because we don't have any clout. But a big company can say, hey, that's our payment terms, and either like it or I'll find another supplier who does. So they can say, well, I'm going to try to collect my receivables really quick, push my payments out 40 days, so I've got time to have some cash and maybe invest that cash, or just have it available. Planning is a big way, though, to be able to do that. If you can do a cash budget and plan those expenses out so you know when you're going to have excess cash and you know when you need cash, and then you invest that excess cash to make some money or possibly pay off your line of credit that you could advance on later, but at least you're going to save interest in the short term. So over-the-counter cash receipts, obviously the cashier is going to ring up the cash register. She's going to collect that cash. She then takes it over to the cashier's department, who's going to then double check it and verify that everything ties out to the register and the cash on hand. Then that's going to go to somebody who then makes the deposit, and then records the supervisor's going to register and prepare the register sheet and send that money to the company cashier. I guess those, sorry, the cashier doesn't send it back to the supervisor. The supervisor reads that register data, again, the register that came off of this salesperson's, and they send that to the cashier. And then the cashier reconciles the both. So they look at what cash came in, what was our register sheet from the supervisor, and then they'll prepare the deposit slip. Now we can have times where there's an over and short, and they're going to monitor that. But I mean, that's just human nature. It can happen. So the cash over and short would be, we look at our sales at $550 and we compare that to our cash, and the drawer has an extra $5. So in that case, it's a credit. It could go the other way, though, where the drawer has a less $5, and then that would be a debit. So the cash over and short could either be a debit or a credit, depending on what you need to make that balance. And then there's a shortage, again, so you can see it. And the supervisor or the cashier are going to monitor those things to make sure it's not the same person who's consistently having these errors. If cash receipts come in by mail, so you're billing out customers and they pay, you'll have people who are tasked with opening the mail, and then someone is going to make a list of all the checks that come in, and then the cashier, a separate person, is going to then take those deposits to the bank and deposit that money, and then someone is going to actually prepare the records and post it into the ledger. So again, it's going to be kind of a split of duties, and one person couldn't necessarily steal without it getting caught eventually down the way. Now our cash payments, obviously, we want to pay in checks or something that's traceable if we can, because cash is, again, easily stolen. But we can have fictitious invoices that are created or fictitious vendors, so we also have to watch for that. We want to limit the ability, the person who signs the checks is going to be someone different who prints those checks out, so there's going to be a segregation of duties there. And then the cash budget, again, always helps to kind of plan when cash is needed and when cash is coming in. A voucher system is where you've got paperwork that kind of follows these transactions. So you'll have somebody who verifies and approves like a purchase order. Then you'll have that matched to a receiving document. So someone put in a purchase order to buy this product. The receiving people approved that, yes, the product came in, and then the accounts payable people are going to match those two documents and then pay that bill. But then that way they see clearly when they're issuing that check, this was approved and this really came in, it's been verified, and then now we can go ahead and pay it. So there's definitely going to be all these different documents. So like here's the purchase requisition, then the purchasing department actually makes the purchase order. Then there's going to be a receiving report that will get matched to the invoice that gets mailed to the accounting department. Then that invoice is going to be approved and a check is going to be cut. So a lot of times this is more of an accounts payable person who matches all of these things and verifies it before the check is paid. Now we can have small payments that we're going to just maybe pay out of a petty cash box. So those are going to be very minor things, small dollar amounts. So maybe you set up a petty cash fund with this is $75. So we debit petty cash and we're going to keep $75 in a lockbox all the time. And that comes out of our regular cash account. So then as we need stuff, so say there is somebody comes in with a freight in type bill and says, hey, you got to pay this freight guy $15.05. So we take that out of the petty cash box. Then maybe we go and we buy some, pens because we're all out and we need those right away. So we take that out of the petty cash box. Maybe we've got to ship something to a customer last minute and we got to take it to the post office. It's $5. Maybe then we bring in a cleaning company and they're not a vendor we've used in the past and they don't want to take a check. We're going to pay them petty cash. So, it's like unique little scenarios. But as we look through the month and these are all of our charges, we've taken the money out of petty cash. So all that should be left in that $75 balance is $3.70. So then we're going to replenish it. So we're going to replenish what we used up. So we charge those off to the applicable expense accounts. And then we credit cash. And again, it'll cut us another check to petty cash. We'll take it to the bank, cash it, and then we'll replenish that petty cash box. And then we do that every month. So again, it'd be somebody's responsibility to manage that. Then what if we say, okay, well, $75 isn't enough. Again, we can cut another check to petty cash coming out of our regular cash account for the $25. Now our petty cash box is up to $100. What if we say, oh, it's too much? Then again, we can take the $20 out of our cash account and go to the bank and deposit it in there. And then we would do the entry to increase the cash account and decrease the petty cash fund. There can be over and shorts in your petty cash fund as well, and they're handled the same way. So we charge off whatever expenses we have. If we're short, we're going to debit cash over and short. If we're over, we're going to credit cash over and short. And then again, because like I said when we started the cash conversation, cash is what people want to steal. So it's very important for an accounting manager or a controller or the assistant treasurer, somebody who's a higher up person, to actually reconcile the bank statement. So the bank statement is going to show us all of our withdrawals, all of our deposits, and kind of what the balance is at the beginning and the ending of the month. So we want to, again, prepare that bank reconciliation. So on the one side, we do our bank balance and come up with an adjusted bank balance. And then on the other side, we do our book balance and we come up with an adjusted book balance. And ideally, those should equal. So this little table gives you a list of the things that are common adjustments. So to the bank, if we have deposits that we have recorded in our ledger, but they haven't gotten to the bank yet, maybe we put them in the overnight deposit on that day and the bank didn't process them until the following Monday. So they're in transit, but we know they exist. The bank doesn't know yet. We'll have to add those to the bank balance. Subtract outstanding checks. We know we've written checks, but they have not cleared the bank yet. The people have not cashed them. So we know they exist. The bank does not. We need to subtract those out. And then there could be some corrections for bank errors or for checks, for like, not checks, but like safe deposit box fees and things like that. Then our book balance, we say, okay, we didn't know, okay, sorry, that's actually where the fees would go. We didn't know about the bank fee, that safe deposit box, so we're going to subtract that from our books. We didn't know that a customer's check bounced, so now we're going to subtract that from our books. We didn't know that we earned interest, or we didn't know how much we earned, so we're going to add that back. Maybe a customer paid us electronically and didn't send us a receipt, so we didn't know it, so we didn't record that yet. And then again, there could be errors that we have. Maybe we transposed a number when we wrote a check. It was for $190 and we put in $910. You know what I mean? Just something, an error that happens. We need to adjust those. So again, here gives you the nice little summary again, the cash balance per book. Then how do we adjust that to get it down to our adjusted balance? our cash balance per books. How do we adjust that to get to our adjusted cash balance? And again, they should equal. So here shows you one worked out. So we've got our bank balance, we add back a deposit in transit, we subtract out outstanding checks, and that's our adjusted balance. We have a book balance, then there's some things that came into our account that we were not aware of, a collected note, interest earned, those we add. Then we had a check printing charge and an NSF check, and that's not our NSF check. That is a customer. So a customer paid us and it bounced and we didn't know it. So we gotta subtract that out. But then now we see that they equal, so we have properly reconciled the account. Okay, those look like the exact same to me, so we'll move past that. Now then the last thing that we have to do though is those items that adjusted the book balance, we actually have to put them into the ledger. So we actually have to do the journal entry. So we collected a note, cash came in, and we reduced the notes receivable. We earned interest, cash comes in, and we record interest revenue. We had a miscellaneous or a check printing charge that goes to miscellaneous expenses, and we reduce our cash. This person who we thought paid, their check bounced, so we're going to put it back into their receivable, and we reduce cash, again, because they still owe us. So then that is our final step to our check reconciliation. So you can see that a lot of this chapter deals with cash, and then what are the best ways to manage it so that there is not fraud or error.